Welcome to our video on the basics of real estate investing. Real estate investing can be a powerful way to build wealth and generate passive income. It's also a great way to diversify your investment portfolio, as it offers low correlation with other asset classes like stocks and bonds. In this video, we'll cover everything you need to know to get started in real estate investing. We'll discuss the different types of real estate investments, including rental properties, REITs, and flipping houses. We'll also cover the process of finding and evaluating potential investment properties, as well as the different types of financing available for real estate investments. We'll also touch on important topics like managing and maintaining an investment property, as well as tips for being successful as a real estate investor. By the end of this video, you'll have a solid understanding of the basics of real estate investing and be ready to take the first steps towards building your own portfolio. So sit back, relax, and let's dive in. Types of real estate investments. When it comes to real estate investing, there are several different types of investments to choose from. Some of the most popular include rental properties, REITs, and flipping houses. Rental properties are properties that are purchased with the intention of renting them out to tenants. The goal is to generate rental income and potentially see appreciation in the value of the property. One of the main benefits of rental properties is that they can generate passive income, and over time, the property can appreciate in value, providing a potential for capital gains. However, rental properties require a significant amount of time and effort to manage, as well as a good credit score and a down payment. REITs, or real estate investment trusts, are a type of investment that allows individuals to invest in a diversified portfolio of real estate properties. REITs are publicly traded and can be bought and sold like stocks. REITs are a great option for those who want to invest in real estate but don't want the hassle of managing properties themselves. However, REITs tend to be less profitable than direct real estate investments, and the returns are often correlated to stock market performance. Flipping houses is the process of buying a property, renovating it, and then reselling it for a profit. This type of investment can be highly profitable, but it also requires a significant amount of time, effort, and money. It also requires a good understanding of the real estate market, as well as the ability to spot good deals. Each type of real estate investment has its own set of pros and cons, and it's important to consider your individual goals, risk tolerance, and resources before deciding which type of investment is right for you. It's also important to consult with a financial advisor or real estate professional before making any investment decisions. Finding the right investment property. Finding the right investment property can be a challenging task, but with the right approach, it can also be a highly profitable one. The first step in finding the right property is to research the location. You want to look for areas that are likely to experience population growth, job growth, and rising property values. Once you have identified potential locations, you'll want to start evaluating properties. One of the most important things to consider is the property's financials. This includes things like rental income, expenses, and cash flow. To evaluate a property's financials, you can use tools like the gross rent multiplier and the cap rate. The gross rent multiplier, GRM, is a simple tool that helps you evaluate the potential profitability of a rental property. It's calculated by dividing the property's purchase price by the annual gross rental income. A lower GRM indicates that a property is more profitable. The cap rate, capitalization rate, is another tool that helps to evaluate the potential profitability of a rental property. It's calculated by dividing the property's net operating income, NOI, by the purchase price. A higher cap rate indicates that a property is more profitable. Both the GRM and the cap rate are important indicators of a property's potential profitability, but they are not the only ones. Other factors to consider include the property's condition, the quality of the neighborhood, and the local rental market. By researching the location, evaluating the property's financials, and using tools like the GRM and cap rate, you'll be able to identify the best investment properties and make more informed decisions when it comes to investing in real estate. Financing your investment. When it comes to financing your real estate investment, there are several options available, including traditional mortgages, hard money loans, and owner financing. Each type of financing has its own set of pros and cons, and the right option for you will depend on your investment goals and personal circumstances. Traditional mortgages are the most common type of financing for real estate investments. They are typically provided by banks and other financial institutions and involve borrowing a large sum of money to purchase a property, which is then paid back over a period of time, usually 15 to 30 years, with interest. Traditional mortgages have lower interest rates and longer terms, making them an attractive option for long-term investments. However, they typically require a large down payment, good credit score and a thorough documentation process, which can make it difficult for some investors to qualify. Hard money loans, on the other hand, are short-term loans that are typically used for flipping houses or other types of short-term investments. They are provided by private investors or specialized lending companies and are typically secured by the property itself. Hard money loans have higher interest rates and shorter terms, which can make them more expensive in the long run. But the process of acquiring them is much faster and less stringent compared to traditional mortgages, which can be an advantage for some investors. Owner financing is when the seller of a property agrees to finance the purchase for the buyer. The buyer makes payments to the seller, rather than a bank or other financial institution. This type of financing can be more flexible than traditional mortgages and hard money loans, but it also has its own set of risks. The buyer may default on the payments, and the seller may be left with a property that is hard to sell. When choosing the right type of financing for your investment, it's important to consider your investment goals, the type of property you're buying, and your personal circumstances. It's also important to speak with a financial advisor or a mortgage broker to help you understand the different options and which one might be the best fit for you. Managing and maintaining your investment. Managing and maintaining an investment property is an ongoing process that requires time, effort, and attention to detail. One of the most important aspects of property management is finding and vetting tenants. This includes advertising the property, conducting background checks, and credit checks. It's also important to have a clear lease agreement that outlines the terms of the tenancy, including the rent amount and the responsibilities of both the landlord and the tenant. Another important aspect of property management is handling maintenance and repairs. This includes routine maintenance like painting and cleaning, as well as more extensive repairs like fixing a leaking roof or replacing a broken appliance. It's important to have a plan in place for dealing with these issues, as well as a budget for unexpected repairs. Managing the finances of an investment property is also an important aspect of property management. This includes setting rents, creating a budget, and keeping accurate records. It's important to keep track of all income and expenses, so you can see how much money your property is making or losing. When setting rents, it's important to be aware of the local rental market and what similar properties are renting for. This will help you to set rents that are competitive and will attract tenants. Creating a budget is also important, as it will help you to plan for future expenses and make sure that you have enough money to cover unexpected repairs and maintenance. Lastly, it's important to keep accurate records of all income and expenses related to your investment property. This includes rent payments, utility bills, and any repairs or maintenance expenses. Keeping accurate records will allow you to track the performance of your investment and make informed decisions about how to manage and maintain the property. In summary, managing and maintaining an investment property requires a combination of finding and vetting tenants, handling maintenance and repairs, and managing finances. By setting rents, creating a budget and keeping accurate records, you will be able to track the performance of your investment and make informed decisions on how to manage and maintain the property.